All right, we're going to go ahead and get started. Thanks everybody for being here today. My name is Jeff Bruskin. I am the founder and managing partner of White Tiger Connections. White Tiger, we are a consulting firm that specializes in working in the public accounting ecosystem. We do three primary things for our clients. We do recruiting, we do mergers and acquisitions, and we do management consulting. And we work with public accounting firms almost exclusively. Um, if you're interested in learning more, you can go to our website, whitetigerconnections.com. Today, we're going to talk about what buyers look for in a public accounting firm that's on the market for sale or that's considering a merger. Um, so a little bit of background, we have about 75 retained clients as of today, Friday, March 8th, 2024, across the United States. About 65 of these clients are public accounting firms, and the delta of 10 are private equity and some financial services, either broker-dealer or RIA. And the non-accounting firms that we have as clients are interested in acquiring accounting firms or merging with an accounting firm. And the public accounting firms that we have in clients, the other 65, are interested in either buying accounting firms, selling to accounting firms, merging accounting firms, or hiring in the accounting discipline. So we're highly focused in this area, and we have a lot of anecdotal evidence that we can give about what buyers look for. And so that's the topic for today's webinar. Um, I think what I want to start with is typically culture is the most important thing of all. And this is something that we see time and again from sellers as being paramount. All of the financial conversations that you can have, all of the synergistic fit between complementary business lines, whether in accounting and tax or in wealth management, or in CFO services and insurance or employee benefit plans or any of the other plethora of ancillary connective services that factor into the core accounting discipline. Culture remains paramount. It's the most important thing for everybody. Um, I think the biggest quantifiable component of culture is how open-minded is the stakeholder who you're working with, either on the buy side or the sell side. If we take the buy side for a second, there are buyers who we encounter that know exactly what they want. They know exactly what they don't want. And believe it or not, these are usually the hardest people for us to work with because oftentimes when they know what they want, they are operating from kind of an older paradigm. And this is something that's endemic within the accounting sector. There's just a lot of stagnation in the market. So we see this a lot with larger public accounting firms that we work with. Firms that are $1 billion plus, or even $250,000 plus, in some cases $100 million plus, have a very well-defined model for what it looks like to acquire a firm. And there's a lot of closed-mindedness. So this is a culture that's not necessarily a positive thing that we experience with larger firms. Um, there are exceptions to that rule, and there are exceptions also within the private equity ecosystem. We see both sides on, larger public accounting firms, and we see both sides on private equity. Private equity has gotten a really bad rap as it has entered into the public accounting sector with a lot of buy-side hunger. It's made, different PE firms have made large investments in some very brand name accounting firms across the country. I would say, in my opinion, more often than not, it has not worked out for either the seller or the PE firm. There's a lot of shedding of clients. There's a lot of non-satisfied staff and partners in some of the larger M&A. And this is problematic. We work with both one or two large accounting firms and one or two larger PE firms that are interested in making acquisitions, that have done so serially and that are open-minded. So as you are considering, if you're a seller, a buyer, especially an institutional buyer, a buyer who is a fair size larger than you, whether or not they have previously made acquisitions, you should interview them for culture. You really should spend a healthy amount of time getting to know them, getting to know what their vision is for the combination of your firm, um, and see if this is a person who you could relate to and get along with and work with and feel the spaciousness to be creative, because a merger or an acquisition should be fun. It should not just be about how many more zeros can we add to the equation. Usually those two things go hand in hand. Similarly for the buyer, right? Culture is going to be paramount to the buyer for the seller. And this is probably even more endemic, like it or not. Sellers in the accounting world it can be very hard to work with. It's not ubiquitously true, but I would say more than half of the time we encounter, unfortunately, again, the stereotype, a lot of crusty, older, closed-minded accountants, and it's unfortunate. You know, I don't, clearly I'm not mincing words, but I think that especially the generation that's getting ready to retire. You guys, if you're watching or listening to this, I received a gracious correction the other day when I called the accounting profession the accounting sector or the accounting industry. And the truth is, I am not an accountant. So I have not had to deal with all of the hubbub that you who are watching this have. The clients who you need to chase endlessly for collecting their information, the way that they treat you, which is as a second class citizen, and you can't get a hold of them, and then the 11th hour when they need something, it's like their hair is on fire and you're the worst person in the world for not being at their beck and call, and they don't pay you all that much, and even what they do pay you, they're a pain in the butt to collect. So from the outside, at least, I get it. But I think that it has created a lot of jadedness, and that's unfortunate because the accounting profession is such a crucial key cornerstone to the U.S. economy. It's basically a recession-proof industry. I certainly believe that, even with AI, even with India, even with larger firms that in some ways are monopolizing different parts of the market. If you are coming out of school with an accounting degree today, you have a very bright future ahead of you, especially if you have the peripheral vision to pick your head up and to look around in the marketplace and to see what is out there for you. So all of that I say because whether you are 69 or you are 29, part of good culture means being open-minded. It means being a constant learner. It means being open to what the person on the other side of the table is saying to you and actually listening to that. And I think, anecdotally, it's very hard for a lot of accountants to do that because, and I say this graciously, every banker, lawyer, financial advisor, real estate broker, insurance broker, any service provider who surrounds the high net worth individual and their closely held entity wants access to the accounting firm. And so accountants, I think, put up this large wall, and it's hard to get through. It's hard to get them to listen, and it's because the rest of the market has kind of used and abused them. But when it comes to the future of the accountant, especially in a sell side situation, having that open-mindedness is going to be the sort of mental receptivity which is necessary to make you attractive to buyers. So I'll give a real life example. I have a firm, it's a couple million in revenue. It's one partner, very profitable. And I have a PE firm that's considering a conversation with that owner. And the PE firm asked me to describe the owner. I said that they have, had a hard time retaining staff, which is true. And, this person is phenomenally technically competent. However, they can be somewhat difficult to deal with. I gave the PE firm a candid, read because I didn't want to waste the corporate development guy's time. We have a great relationship and he's going to find out for himself sooner or later. It took a lot of convincing to get the PE firm to take a conversation just after I gave a personality profile. And this is true, on the one hand, if you're a seller, you could say, well, I want a good culture. I don't want to work for anybody. And I hear that all the time. And it makes sense to me, right? If you've spent your career working for yourself and being your own boss at 65, 69, 71, you don't want to go and work for somebody else. And in a sense, you kind of have to do that because you're not going to get 100% of your cash. You have to remain upfront, right? You need to remain involved throughout the vesting period. So the transition, right, is in a sense, you're going to work for them, but I want to work for them in an environment where it doesn't feel like I'm working for them. And that's what I hear often. And it's possible, but you have to be the inverse as well. You have to be receptive to them just like they're going to be receptive to you. Otherwise, we're starting with a losing formula. So I'm now in the process of coaching the seller through how to represent himself in a receptive way so that the PE firm, is really open-minded to working with him as well. It's a two-way street, treat others the way you want to be treated, that whole thing. And it's actually quite true. Um, so culture is big, and I know I spent a lot of time on that, but happy to talk about that at length. It's big in every sector in M&A. It is especially big in accounting because of the endemic problems with staff and some of these subtleties which exist in this market that don't exist in other markets or professions because of, I guess, the nature of what it is, which is, taxes and accounting and auditing is a very technically driven skill set, and it produces a lot of personalities that are maybe not the most gracious, unfortunately. Sometimes there are exceptions, and those are great. So culture is the biggest thing I want to talk about. What else do buyers look for? So let's go into some of the more technical metrics of what buyers look for. So one major thing is higher value, lower volume clients, right? The practices which are, I have heard them ungratuitously called tax mills or 1040 sweatshops. The higher volume practices generally are less attractive to buyers. The reason is because, not because it is a lower annual gross income sort of household client. It's not anything against the client. It's that the business model of doing a lot of lower value work requires a very sophisticated operation, quality control process, staffing infrastructure in order to support and extract a healthy profit line from. Whereas higher value and lower volume client bases, you need more people who are highly competent, which has its own challenges, but it's less personalities to manage internally and it's less personalities to manage externally. So those practices we typically see being not more salient. We certainly transact regularly on the tax mills, if you will. But the ones that are higher value client bases, lower volume, they generally will go for a higher multiple. Another thing that makes a buyer really happy is niche industry practices, right? And it doesn't have to just be one industry. If you do especially if you do industries which are strongly complementary with each other, you become extremely attractive to private equity buyers, right? And maybe even public accounting buyers that have a concentration in those particular industries. So what do I mean by that specifically? Well, let's say construction, manufacturing and distribution, real estate, and supply chain and logistics. Those are very interconnected sectors, right? Maybe healthcare, biotechnology, or biopharma laboratory type things within the greater life sciences. Those are, that's a niche, but it's also an ecosystem of niches. So a PE firm that has a portfolio of companies in that space, you're going to be beneficial to them as an accounting firm that they're acquiring, because not only can you serve their clients from an accounting, tax, maybe audit solution standpoint, but they also have other companies that have the ability to serve your clients. So it becomes a multiplicative play when you have a niche industry focus, and value lies in the eye of the beholder. So where in the open market, you may have a 4 to 6 times multiple on EBITDA, to that highly interested buyer, you may be looking at 7 to 9 times the multiple on EBITDA, depending on a number of other factors in your practice, such as the relative size. A $1 or a $3 million practice is not going to go for that kind of a multiple. A 10 or a $15 million practice certainly can. And that's a good segue. Another thing that buyers look for: larger practices are better. Now, I will make an exception to that. I recently spoke to one of the chapters of the New Jersey State Society of CPAs. I'm here on Long Island. I traveled over there and spoke to about 35 accountants. Most of them were, I would say, under $1 million in top line revenue. There were a handful in the room who were probably $3, $5, $10 million either partners or managing partners. So this is a smaller firm audience. And a number of the smaller firms, the under 100 million in the room, were considering merging together to be a larger firm in anticipation of retiring and then being scooped up by a PE firm or a larger accounting firm, being more attractive, maybe having a healthier multiple. I strongly advise against that strategy. If you have not already built the infrastructure, you have built the relationships, you have built the understandings, it is going to be exponentially, and I mean exponentially, more difficult to put forward a narrative to any large buyer that you guys have your ducks in a row internally, even for an acquisition at all. You are better off staying independent if you are at the point of retirement. Tell the true story. Um, Alternatively, if you're younger, if you are considering what the rest of your career looks like, if you are considering a roll-up operation, more is better. The bigger you build your firm, the faster the multiple will increase. So talk with me if you yourself are considering what your longer term exit strategy looks like. Myself and my partners can help you to position your firm in a way where you're going to be on a trajectory to get more bang for your buck when you're ready to exit. Um, let's see, what else do buyers look for? Buyers look for a healthy staff, right? We like a healthy staff. That's something else that my firm can consult on. Um, Talent in accounting is very tough. We all know it. It was hard before COVID. It is what I call calamitous now. There are not enough people. The people who are competent are overcompensated by large firms. Add that to the jadedness and the cultural challenges we've already talked about. It's very difficult to get people who are any good to move. If you're any good, you're working for a firm, you're probably very well protected, both psychologically and in terms of your pay, so that you don't leave because you're one or two or three other people's succession plan, right? If you're a reasonable age. So it's tough, but there are solutions. Um, so talent, figuring out how to solve for the talent question, definitely something that buyers look for is a stable infrastructure. Doesn't mean that you can't sell a firm that does not have a healthy staff. It just means that that is a factor which will play into how a buyer looks at you, how a buyer looks at you culturally, how a buyer looks at you in terms of their commitment from an operating cash perspective and from an uncertainty perspective. They now have to take responsibility for either based on their existing infrastructure or staffing the holes in your practice to support, serve, grow your client base. So it's more of a burden and it factors in, and we can talk about that offline if you're interested. Staff is very big. What else do buyers look for? Buyers look for practices that are more digitized than not. We do not like paper. Paper is bad. Paper is evil. Um, if you have your own process of working with paper, that's fine. You do not need to use software if you have never used it before. You don't need to go from on-prem to the cloud if you have never done that before. We can come up with solutions where you yourself and your workflow as a seller is as you want it to be. That is an achievable solution. However, if you are 2, 3, 5, 10 years away from selling your practice and you're thinking about what a buyer looks for, your staff, your infrastructure should not be on paper, should not be on-prem. If you have runway in front of you, cloud is better. More autonomized workflow is better because it is more turnkey to sell into a more strategic buyer. I'm going to take a second and talk about the difference between an additive buyer and a multiplicative buyer, right? The general additive buyer is another public accounting firm. They see you for your clients. They want your clients. Maybe they want your staff. They want your revenue. That is an additive buyer. A multiplicative buyer, a great example of that is the PE firm that I gave earlier that works in the life sciences sector. They see your niches in life sciences, right? In those two directions. Your firm can serve their clients, their portfolio can perhaps serve your clients, and there are exponentially, multiplicatively, more opportunities that exist from that kind of a partnership. You can bet that that is going to have a much more attractive multiple. If that firm sells. Now it becomes more turnkey, right? The niches are great if it's a digitized practice. What does digitized mean, right? The biggest thing is what the workflow looks like. So the softwares are connected to one another. Your staff, if they are not fully remote, that's okay. They could be hybrid. They at least should have the ability. And it should not just be like, if another COVID happens, we can go remote again. They should be accustomed to working remotely. In the event that your buyer wants to close your office, in the event that your buyer wants to downsize your office, in the event, and this is the most likely thing of all, that your buyer is looking to have other offices or remote staff that integrate with your existing physical operation. So a digitized practice is software, it's your staff, and it is your client's behavior. Are your clients used to? I heard someone say, I thought this was quite funny. My clients usually do not darken my doorstep with their presence. Um, do your clients darken your doorstep with their presence? If they are high value clients, we're talking like $10,000 1040s or, large CFO engagements that you go and see them, that's different. But if you have 500 or 1,000 or $1,500 tax returns that are coming to your office, and you have quite a few of these, that's hopefully you have a little bit of runway in front of you, and that you have the opportunity to transition your clients into a different behavior, a behavior where you are working with them more remotely. There's two reasons why this is a beneficial thing for you to consider. The first is it will allow you to have a better flow in your day. Even if you want to meet with all of these clients, which I'm not convinced is 100% necessary for you to have a 30-minute or an hour meeting, they still will not spend time in your lobby speaking to your secretary. They won't feel like they can drop in and just see you and see your staff. And there's a lot of firms I talk to, especially on the smaller side, that feel like that physical situation is what makes it so attractive. I understand that, but a lot of buyers do not, especially if it's a higher volume client base. The second reason why it's better for you is a lot of accounting firms are not being billed for the time that they're spending physically with their clients. If somebody just drops off a stack of paper, which isn't a great thing for your workflow, your company anyway, and they end up chatting with your secretary or one of your staff or you for 30, 45 minutes, that's not time you're billing them for. Right? Generally speaking, it doesn't work that way, especially if there's a lot of inflow outflow during your busiest time, tax season, um, or extension deadline season, right? So these are things that as you streamline them, it will become easier for you to bill for this and build workflows and processes that are more digitized, more autonomized, more turnkey for your eventual buyer. Those are the main things that I see buyers looking for. There are nuances between small firms, medium-sized firms, larger firms, what buyers look for. Here's the closing point that I would like to make. As we, move forward into the age of AI, into, post-COVID, more remote work, um, there are firms I see popping up which are very entrepreneurial, what I would call modern accounting firms. There are people I know, there's a couple of guys in upstate New York who left a big four firm. They run in like 2 years. They've grown this thing to like $3 million top line. They're like, yeah, we'd like to get to 30 to 40 million and then sell it, 5, 7, maybe 10 years. And I think they'll do it. There are a lot of firms that are popping up, the new firms of today. They exist. They are very entrepreneurial. They are very accustomed to using technology, working with remote employees, understanding how to train and hire for self-motivated employees that can operate autonomously on a remote basis, that can serve clients, that can leverage either outsourced teams or overseas teams or in-house teams where the senior person is managing the client relationship and the more junior person is actually doing the compliance and the review work. And that frees up the senior people to be very committed to exceptional client service, right? White glove, selling new business. And if you are a specialist, you know what you're talking about. You could shake a tree and there's business that falls out of it in this sector. There are so many opportunities to beat the big firms on pricing and provide much better service. And if you do that for a little while, word is going to get out and you are going to balloon. These firms are doing nothing that is fundamentally undoable by the guys in their 40s and 50s and 60s. So if you are thinking about selling, have a conversation with me or have a conversation with anyone who you admire in the industry who's doing some interesting things, and put yourself in that cultural position where you are open-minded to what they're saying. Don't just think about all of the challenges and obstacles, which certainly exist for making the transition from what you've always done to how they do it. But really listen to them. and talk with me or talk with another consultant who you trust in the sector about how can you take your unique situation and apply some of the same principles that they're doing as you move forward closer to an exit. It will benefit you then at the time of exit in the multiple and the security that you have, in the work-life balance that you have during the integration. It will also benefit you now on your journey to getting there. Does anybody have any questions? Thank you for listening to my spiel today. If you have any feedback also, please feel free to shoot me an email or a LinkedIn message. Check out our website. White Tiger Connections is our company. And have a great weekend, everybody. See you next week. Bye-bye.